Alright, in this episode I want to talk about the 7 wealth killers. In the previous episode I did talk about a couple in their mid-30s making about $72,000 a year and how they went on to become millionaires by the time they retired at the age of 65 to 67, as you can see here. So if you look around here, they hit the millionaire mark by the time they were about 65 years old. Now, I just wanted to make a follow-up video just to show you the devastating effect your spending habits can have on your retirement savings, and hence, the 7 wealth killers. The first one that I want to talk about, lifestyle inflation. So what that means is the more you start making, and if you're in the habit of, instead of saving more, you're spending more because you have more, it is going to significantly impact the amount of money that you can save, and therefore is going to dig into your retirement savings ultimately. First thing that I want to talk about is something called as lifestyle inflation. What that means is the more money you make, the more things you find to spend money on. There are two main components to it. One is the home mortgage and one is the auto loan. Now both have devastating effect on your finances and your retirement savings. Let me show you. So let us look at this couple's cash flow table. So if you look at it, for 2025, it just shows that your expenses are a little more than your income, so they're going to dig into their savings a little bit to cover for the expenses. Not very uncommon, but as you can see, eventually the income catches up with the expenses, and then you're starting to be more on the positive, and then from then on, it just keeps going more and more, increases over time. Now let us look at their debt for now. So I just modeled 3 basic scenarios. Auto loan and this college tuition. I'm not talking about college tuition yet. So their auto loan is $15,000, 3.9%. Now, if you were to go, let's say you go and buy a really expensive automobile. Let's say you go buy a BMW, and now you're down $50,000. Now your payment is probably going to be closer to $1,000. Even with that, let's say even if you're paying $900. It takes you 5 years to pay that off. Let's say that's your payment, okay? Just by that alone, when you look at the lifetime cash flow, just look at it. Now you're $14,000 under, and now it's going to take you 5 years to start being on the positive again. Just that one little change. This is a dagger. Look at your savings. It's dwindling over time. You had about $30,000 before, and now it's coming down all the way to $10,000 before it starts going up. The next point that I want to make is home and real estate. So if you go to the primary residence here, your current residence is worth $400,000. Let's say you move into a $1 million mansion. Okay, let's say you move to a house that is $600,000. Okay, and then your mortgage balance, let's say, is now $450,000, and your monthly payments are $2,500. That's 5.25. You'll be paying that off in 30 years. So this sounds about right. Okay, 29 years, 30 years roughly. Okay, save that. Now you go back to your lifetime cash flow. Now look at that. This is a complete mess. There you go. You're starting off with $25,000. There's no way you can sustain this thing. You're going to go completely broke very soon. And it's negative savings. Look at it. It takes you almost 15 years before you start finding yourself in the positive. You essentially killed your retirement savings just by that move. So this is vitally important to control your expenses, specifically your home and your auto loan. The next big ticket item is the high interest credit card. So if you go to debt, you have auto loan. I'm just going to let's say you have credit card debt on top of it. I'm just going to put the auto loan back because I don't want to completely skew everything. Okay, and then I'm just going to say your payment is going to be $300. That's fair enough. Okay. Now let's go to your credit card debt. Instead of $2,000, okay. Now with that change, I'm going to change the home mortgage also, because I just want to show you how much your credit card debt can. 400,000, you owe 250, and your payment is 1750. Okay, you be paying that out by 2043. There you go. Alright, fair enough. I changed a few numbers here and there, so bear with me. Now let's go to debt and then make that credit card debt roughly, let's say you have a $20,000 credit card debt. At 25%, you're probably going to be paying $1,500 a month. You'll pay that off by 2020. Okay. There you go. Now look at the lifetime income projection. No, lifetime cash flow. Look at that. Just the credit card alone. Everything else stays the way it is. Look at it. You're now in the negative until 2030 for the next 5 years. So living paycheck to paycheck over the next 5 years. The next big ticket item that I want to talk about is poor tax planning. This is essentially failing to optimize taxes. That is, not using any tax advantage accounts like your 401k that you see over here. That's fully tax deductible. You'll be paying less money in taxes. You can maximize your contribution to your 401k. Impulse spending is another big ticket item, because frequently, when you have the ability to generate more money, you have a natural tendency to buy more and more things that you never needed to begin with, but you just want to buy simply because you just saw that you're getting more money in. You need to change this mindset. This is a mindset problem. The more money you get, the more you should be saving. If you change it to that mindset, you will be seeing more money as more savings, which means more investments, which means more time for those investments to grow, which means more money in your pocket at the time of retirement. The next item is what I call the emergency fund. If you don't have enough money in the emergency fund, what's going to happen is at the time of necessity, you're going to be forced to sell in a down market in order to generate the money if you have invested the money. And that is devastating in terms of long-term growth, because you don't want to sell stocks or mutual funds at a loss. It's the reverse of compounding. So the more money that you have available for emergency funds, the less reliance you have on selling stocks and mutual funds, which means more money in your pocket. The last thing that I want to talk about is neglecting financial education. Now, poor money management, bad investment choices, and the lack of financial literacy can lead to very, very expensive mistakes. 30 years ago, I used to make some of these mistakes, but my mistakes were not too costly because I really didn't have much money to play with. But over time, as I educated myself using the various tools that I've showed you in the past in my previous videos, and some of the tools that I will be showing you in my next few videos, I was able to really go from zero to well-educated financially to be able to manage my own money. I've never used a financial advisor in my life. As a matter of fact, as Warren Buffett says, financial advisors don't make very good investors. So the best advice that I can give you is educate yourself. And the whole goal of this channel is to give the education that you need based on the experiences that I have. And I was able to retire pretty comfortably in my late 50s. So I want to pass on that information to you so that you can benefit from my experience and what I've done. Most importantly, my advice to you is, after you have saved enough for your emergency fund, invest the money in stock market. Invest the money in mutual funds. Do not buy stocks, because for most people who do not know how to analyze stocks, it's a very risky business. Mutual funds are the way to go. That's not to say that you're not going to have your ups and downs. You will be, because stock market always goes up and down. But by and large, index funds over the last 100 years have returned well over 10%. And so it's a safe bet to say that if you invest in stock market for the long term, you are very likely to end up having significantly more money than you would have if you were just simply to put that money in a low interest bank account. Because sooner or later inflation is going to catch up, and that money that you have in your bank account is going to be worthless if you don't invest the money. You need to invest money in securities that can account for inflation, and the stock market is one of the best places to invest. I suggest looking at index funds. They are very low cost, and I wouldn't say they're low risk, because stock market innately has a risk associated with it, but the rewards are plenty when you compare it to the risk. And indexing means you're essentially having a skin in the game, investing in hundreds of companies, but they will do that for you. You don't have to break your head trying to figure out what companies to invest in. That's my best advice. On that note, I'm going to end this video, and I'll see you in the next video. Bye-bye.